Hello, and welcome back to the channel. If you're a serious investor looking to navigate the complex markets of 2026, you're in the right place. After a period of concentrated gains, high valuations, and shifts in Fed policy, the investment landscape is changing. Today, we're cutting through the noise to bring you the top, most specific, and credible investment advice for the stock market in the year ahead, sourced from institutions like Morgan Stanley, JP Morgan, and PIMCO. We'll also anchor our strategy with the timeless wisdom of the Oracle of Omaha, Warren Buffett. This isn't about chasing hot stocks, it's about building lasting wealth. Let's dive into the three core pillars of our 2026 investment strategy. Pillar 1. Navigating sector and style. Dispersion. First, let's address the dominant theme of the market today: the AI concentration risk. Looking back at the last few years, we've seen a tremendous technology-driven rally. It has been exhilarating, but as sources like PIMCO and JP Morgan highlight, it has also created a critical risk: the high concentration of returns in a handful of mega-cap tech stocks. This isn't just a rally, it's a market phenomenon largely driven by the AI supercycle, where a small number of companies have accounted for a disproportionate share of the S&P 500's gains. This level of market concentration, where the fate of the entire index is tied so closely to a few names, is historically unusual and introduces a significant systemic vulnerability. If sentiment were to shift on just one or two of these giants, the ripple effect across the broader market could be substantial. It creates a scenario where passive index investors may believe they are diversified, but in reality, they have a heavily concentrated bet on a single industry and a few specific companies. While the AI arms race is undeniably a powerful, long-term economic catalyst with the potential to reshape industries, there are growing concerns about the sustainability of some valuations. We've seen stock prices detach from underlying fundamentals like revenue and earnings, fueled instead by narrative and future promise. Now, the market's focus is beginning to shift from visionary technology to the hard realities of execution and clear monetization strategies. The question is no longer, can they build it? But how will they profit from it and when? Investors are starting to demand a tangible return on the massive capital expenditures being deployed. The market will begin to differentiate between companies with a clear, profitable application of AI and those simply riding the wave of hype. So, what's the takeaway? It is not to abandon technology, instead, it's to maintain exposure to genuine AI innovators, but to be far more selective. Don't simply chase the highest valuation or the most exciting headline. The prudent approach for 2026 is to look for companies with strong, consistent free cash flow and a disciplined, clearly articulated path to profitability that exists outside of just future hype. Seek out the businesses that are already using AI to improve their margins, capture market share, and generate real cash today, not just promising to do so in a distant future. This brings us to our second key theme: the value reversion opportunity. History teaches us that markets move in cycles, and periods of extreme concentration are often followed by a broadening out. Beneath the surface of the pricey megacaps, PIMCO notes that value-oriented stocks, companies that trade at a low price compared to their fundamental worth, are appearing more attractively priced relative to historical averages. The gap between the most expensive growth stocks and the cheapest value stocks has widened to levels rarely seen outside of major market bubbles. This significant valuation spread suggests a powerful potential for mean reversion over time, where undervalued stocks catch up to their overvalued peers, restoring a more traditional market balance. Many traditional profitable companies in sectors like industrials, consumer staples, and financials have lagged behind, overshadowed by the tech narrative. These are businesses that form the backbone of the real economy, generating steady profits and dividends. As interest rates likely decline or stabilize in 2026, the environment becomes more favorable for them. When the cost of capital is no longer near zero, investors become more discerning. Capital is expected to broaden its search for yield and reasonable valuations, flowing away from speculative growth and toward businesses with proven durability and tangible assets. The takeaway here is clear. it's time to rebalance your portfolio to include a greater allocation to value stocks. This doesn't mean abandoning growth, but rather creating a more resilient, all-weather portfolio. Look at sectors that were out of favor but have strong, sustainable business models and are trading at attractive multiples. Think about high-quality industrials that are essential to infrastructure, certain consumer staples with pricing power that can withstand inflation, or even well-capitalized, undervalued financial services companies poised to benefit from a stable economic environment. This strategic shift can provide a crucial defensive buffer while positioning you for the next phase of the market cycle. Finally, let's look at our third area of opportunity: the small cap catalyst. Another area of interest for 2026, as noted by Silvercrest Asset Management Group, is small cap equities. For years, these smaller companies have been left in the dust by their large cap counterparts. They highlight a few potential catalysts that could reverse this trend. First, attractive valuations. The valuation gap between the Russell 2000 Small Cap Index and the S&P 500 Large Cap Index is near multi-decade highs, suggesting significant room for appreciation. Second, diversification benefits. Small caps offer exposure to different parts of the economy and can reduce a portfolio's reliance on the mega-cap tech names. And third, they have a likelihood of amplified performance from domestic economic stimulus and lower to stable interest rates, as these companies are often more sensitive to the health of the U.S. economy. Small caps are often more sensitive to the domestic economy and have lagged the major indices. This is partly because higher interest rates make it more expensive for them to borrow and invest for growth. However, as the interest rate environment stabilizes or improves, this headwind could turn into a tailwind. A resilient domestic economy, combined with lower financing costs, could unlock significant operating leverage for these nimble companies, leading to accelerated earnings growth that the market has not yet priced in. The takeaway: consider carving out a dedicated allocation to this asset class. You can use small cap-focused ETFs for broad exposure, or, for those willing to do the homework, select individual companies with strong balance sheets and clear competitive advantages to gain exposure to this potential rebound. This is a diversification play that could offer outsized returns if economic growth remains resilient. In summary, for Pillar 1, the strategy for 2026 is one of deliberate rebalancing. It's about evolving your portfolio strategy from pure growth chasing to a more balanced and resilient structure, strategically favoring value and small cap segments alongside your core holdings of selective, high-quality technology leaders. This nuanced approach prepares you not just for continued growth, but for a market that is likely to become much broader and more discerning. Pillar 2: incorporating macro tailwinds and risks. In our second pillar, we elevate our perspective from individual companies to the grand chessboard of the global economy. Understanding the powerful macroeconomic forces at play, the tailwinds that can propel your investments forward, and the risks that can capsize them, is not just an academic exercise. It is a crucial component of a robust, all-weather investment strategy. These are the currents and tides of the market. Ignoring them is like setting sail without consulting a weather chart. We'll dissect 3 key macro themes that are top of mind for the world's leading financial institutions: the impact of monetary policy, the structural shifts from geopolitics, and the persistent debate around market valuations. First, let's talk about the rate cut effect. Both J.P. Morgan and Morgan Stanley project a resilient global growth outlook for 2026, supported by a pivotal factor: expected rate cuts from the Federal Reserve and other central banks. After a period of aggressive tightening to combat inflation, the pendulum is swinging back. This shift from a restrictive to an accommodative monetary policy is arguably the single most important tailwind for markets in the near to medium term. Why? Because interest rates are the financial world's gravity. When they are high, they pull down on asset valuations. When they fall, they allow those same assets to float higher. Morgan Stanley's analysis specifically suggests the Fed may have more room to cut than the market currently expects, which they describe as a very good setup for equities typically. This is a critical insight. If inflation continues to cool faster than anticipated, it gives the central bank a green light to stimulate the economy more aggressively. On a fundamental level, lower rates reduce the cost of capital for corporations. This means it's cheaper for them to borrow money to invest in new projects, expand operations, or buy back their own stock, all activities that can drive earnings growth. Simultaneously, for investors, lower rates make the potential returns from risk assets, like stocks, far more compelling compared to the safer but lower-yielding returns from fixed-income instruments like government bonds. This is the concept of the equity risk premium at work. As bond yields fall, the extra potential return you get from taking on the risk of owning stocks becomes more attractive, driving capital into the equity market. The takeaway here is clear. A supportive monetary policy environment should act as a strong foundation underpinning the broader equity market. This macroeconomic tailwind suggests that an overweight position in stocks relative to other asset classes may be warranted, as Morgan Stanley recommends. However, this entire thesis is contingent on one crucial variable. Inflation must continue its downward trend toward the Fed's target. Any unexpected resurgence in inflation would tie the Fed's hands, delay or reverse rate cuts, and turn this powerful tailwind into a punishing headwind. Therefore, while the outlook is positive, it requires constant monitoring of inflation data. Next, we turn to a more structural, long-term theme: geopolitics and fragmentation. A major trend highlighted by J.P. Morgan and T. Rowe Price is the splintering of the post-Cold War global order into competing economic and political blocs. The era of hyperglobalization, characterized by frictionless trade and just-in-time supply chains stretching across the planet, is giving way to a new paradigm. In this fragmented world, resilience and security are becoming paramount for both nations and corporations. This isn't just a political headline, it's a powerful economic force that is creating a new wave of investment opportunities where supply chains, energy access, and national security converge. Companies are no longer just optimizing for cost, they are optimizing for stability and predictability. The takeaway is to actively invest in companies that are the direct beneficiaries of this tectonic shift. This means looking beyond traditional sector classifications and thinking thematically. We can break this down into three key areas. First, reshoring and domestic infrastructure. Identify companies benefiting from manufacturing, moving closer to home or to allied nations. This includes industrial automation firms, construction and engineering companies, and logistics providers focused on domestic networks. Second, energy security. The scramble for stable energy sources is a multi-decade tailwind. This favors investments in stable domestic energy producers, LNG export facilities, and the critical infrastructure needed to support a more resilient energy grid, including renewables and grid modernization technologies. And third, defense and cybersecurity. In a more contentious world, government and corporate spending on both physical and digital security is non-negotiable. This creates a durable demand for defense contractors, and, perhaps even more importantly, cybersecurity firms that protect critical data and infrastructure from state and non-state actors. This is a long-term, structural shift that will reward companies with robust, secure, and strategically positioned operating models. Finally, we must address the valuation versus correction debate. Despite the positive tailwinds we've discussed, a significant risk looms over the market: the threat of a sharp correction. As the CEO of Goldman Sachs has warned, a 10 to 20% drawdown in equity markets is always a distinct possibility in the next 12 to 24 months, particularly as stretched valuations are reassessed by the market. This isn't fear-mongering. It's a realistic assessment of market mechanics. When prices run up quickly, as they have in certain segments, they become vulnerable to shifts in sentiment or earnings disappointments. This risk ties directly back to the concentration risk we discussed in Pillar 1. If a handful of mega-cap stocks have driven the majority of market gains, a stumble in just one or two of them could trigger a broader market decline. The takeaway here is not to panic, but to prepare. This is where the timeless wisdom of Warren Buffett becomes your shield. The key is to prepare, not to predict. Instead of trying to time the next 10% drop, a fool's errand, you should focus on a consistent, long-term, business-focused approach. Buffett's strategy through decades of market cycles is crystal clear. Own high-quality businesses with durable competitive advantages and hold them through the inevitable periods of volatility. His recent actions, such as trimming certain positions and allowing Berkshire Hathaway's cash pile to swell to record levels, are not a prediction of a crash. Rather, they are a masterclass in discipline. It's a signal that he finds fewer opportunities that meet his strict criteria for value at current market prices. This reminds us of his most famous counsel. We simply attempt to be fearful when others are greedy, and to be greedy only when others are fearful. For you, this means you do not panic sell into a drawdown. Instead, you should mentally reframe a correction as a potential opportunity, a sale on the great businesses you've always wanted to own. This is when your discipline and your cash reserves become your greatest assets, allowing you to be greedy when others are fearful, but only if you have the dry powder on hand to act. Pillar 3. The timeless strategy, anchoring with value investing. The Buffett principle: buy businesses, not stocks. The most consistent and powerful advice for 2026 or any year comes from the principles that built Berkshire Hathaway. This isn't just a clever phrase, it's a fundamental shift in perspective. Buffett doesn't invest in flickering stock tickers. He buys pieces of actual businesses at a reasonable price. Before any purchase, you should be asking, if I had the money to buy this entire company, would I be happy with its long-term economic prospects? This simple question forces you to think like an owner, not a speculator. This ownership mindset involves a deep dive into a company's economic moat, its sustainable competitive advantage. Is it a powerful brand, a network effect, a low-cost production process, or a government patent? A wide moat protects the company's profits from competitors, just like a real moat protects a castle. You must also operate within your circle of competence, meaning you only invest in businesses you truly understand. And crucially, you must always demand a margin of safety, buying the business for significantly less than its estimated intrinsic value. This provides a buffer against bad luck or analytical errors. The takeaway: for your 2026 research, focus on the vital signs of a healthy business. Look for a consistently high return on equity, or ROE, ideally above 15%. This indicates that management is effectively using shareholders' money to generate profits. Scrutinize the balance sheet for a low debt-to-equity ratio. A company not burdened by heavy debt is far more resilient. And most importantly, demand strong and growing free cash flow. This is the actual cash left over after a company pays for its operations and capital expenditures. It's the money that can be used to pay dividends, buy back shares, or reinvest in the business, all things that create value for you, the owner. These metrics are your quality filter, helping you identify robust businesses that can not only survive but thrive during a potential economic slowdown or a market correction. Holding the forever stocks. Buffett's portfolio is famously concentrated in companies he plans to hold forever, businesses like Coca-Cola or American Express. These aren't random picks. They are what he calls wonderful companies at a fair price. These are businesses with immense pricing power, meaning they can raise prices without losing customers, and a durable global brand that is etched into the minds of consumers. They are the defensive anchors in any volatile market, the core compounders that form the bedrock of a portfolio. This strategy isn't about collecting dozens of stocks. It's about making a few high-conviction bets on exceptional businesses and giving them decades to work their magic. Your goal should be to find your own forever stocks, companies whose products or services you believe will still be in demand 10, 20, even 30 years from now. The takeaway: review your portfolio with this long-term lens. Do you own stocks or do you own businesses? Ensure you have a foundation of high-quality, dividend-paying companies. These aren't just numbers on a screen. They offer a powerful psychological safety net. The regular, continuous income stream they provide acts as a tangible reward for your patience, helping you stay calm and committed when the market gets bumpy. This is where Buffett's other classic quote becomes particularly relevant. Our favorite holding period is forever. Adopting this mindset is the ultimate defense against the emotional, short-term trading that so often destroys value. It forces you to focus on business quality and long-term prospects, tuning out the distracting noise of the daily market chatter. The power of doing nothing. In a world that glorifies constant action, one of Buffett's most potent strategies is strategic inaction. As Nasdaq recently noted, a key takeaway from Buffett's actions in a high-valuation environment is the importance of remaining calm and disciplined. In recent quarters, Berkshire Hathaway has been a net seller of stocks and has allowed its cash pile to swell to record levels. This isn't a sign of fear. It's a masterclass in patience. It reminds us that doing nothing, or more accurately, holding cash while you wait for the right opportunity, is not just a valid strategy, it's a powerful one. Cash is not a lazy asset. It's a call option on future opportunity. It represents strategic firepower, ready to be deployed when the market offers up a bargain. Resisting the urge to be constantly invested is a hallmark of a professional temperament. It means you are playing your game, by your rules, and not getting swept up in the market's manic-depressive mood swings. The takeaway: don't feel pressured to constantly be fully invested, especially when valuations seem stretched. Having liquidity is what allows you to truly follow Buffett's most famous advice: to be greedy when others are fearful. That cash on the sidelines is your ticket to take advantage of that inevitable 10-20% market drawdown if and when it materializes. While you wait, don't let your cash sit idle. Diversify your cash holdings into short-term, high-quality fixed income like treasury bills. This allows you to earn a safe, respectable return while you wait for what Buffett calls the fat pitch, that one perfect, unmissable investment opportunity. Patience, backed by liquidity, is the ultimate competitive advantage in investing. Actionable investment ideas for 2026. 1. Strategic tech exposure, the next wave. We know AI is key, but the risk is concentrated in the top few. Morningstar and Nasdaq suggest looking at companies critical to the AI infrastructure, but with more diversified operating segments. Example: companies involved in advanced chip manufacturing or hyperscalers that are investing heavily in AI R&D but have established profitable cloud and advertising businesses. These names often offer a strong financial position to thrive while AI matures. 1. Global diversification, the non-US play. Morgan Stanley predicts US equities will outperform, but JP Morgan and Morningstar emphasize the attractiveness of non-US equities due to still attractive valuations and potential upside in emerging markets like Brazil and Mexico. A weaker US dollar, as anticipated by some, would also boost returns for US-based investors holding international assets. The takeaway: don't suffer from home bias. Allocate a portion of your capital to broad, low-cost international or emerging market ETFs. 1. Defensive and resilient sectors. This goes back to the Buffett model of quality. Look for non-cyclical, recession-resilient businesses. These include quality healthcare, companies with established drug pipelines and inelastic demand, consumer staples, brands that people buy regardless of the economic climate, e.g., food, beverages, personal care. These sectors may not be flashy, but they offer stability and dividend growth, perfectly aligning with the strategy of buying and holding durable businesses. 1. Thoughtful fixed income. While we are focused on stocks, a good investor never ignores their balance sheet. With the Fed likely cutting rates, JP Morgan recommends focusing on fixed income with shorter maturities, around 5 to 7 years, to manage risk while still capitalizing on the current rate environment. Fixed income plays a crucial stabilizing role in a balanced portfolio, especially if a correction occurs. Conclusion and final action plan. As we look toward 2026, the market presents a mixture of promise and pressure. The structural forces of AI, geopolitics, and fiscal policy are creating both opportunity and concentration risk. The key is discipline. Your 2026 action plan should focus on these 5 steps. 1. Rebalance. Shift some capital from highly concentrated, high-valuation growth stocks into attractive value and small-cap segments to benefit from potential mean reversion. 2. Fortify. Increase your allocation to high-quality, defensive businesses with wide moats, strong fundamentals, and consistent cash flows. The Buffett staples. 3. Diversify. Don't overlook non-US markets. Use low-cost ETFs to capture potential upside in developed and emerging markets. 4. Maintain liquidity. Hold a tactical amount of cash or short-term fixed income. Remember, Buffett's greatest tool is patience, and cash is the ammunition for opportunity. 5. Automate. Stay true to your long-term goals by consistently dollar-cost averaging into broad market index funds, which remain the foundation of any sound strategy. Ultimately, 2026 will reward the disciplined, long-term investor. As Warren Buffett famously summarized, the single best piece of investment advice is simple. Do not take a lot of silly chances. Stick to what you know, focus on value, and let compounding do the heavy lifting. Thank you for watching. If you found this advice valuable, please hit the like button and subscribe for more professional market analysis. We'll be back next week to discuss more. Until then, invest wisely.